Subscribe now and press the bell icon. Never miss an update.
This video will be about consolidated reserves, also known as retained earnings. The consolidated accounts must show the parent's position added to the subsidiary's position on a line-by-line basis. But the retained earnings figure is an equity account and it is calculated by using a special working. Without this special working, the parents will not be able to find out what the retained earnings are and the balance sheet will not balance. So the retained earnings figure tries to show what the parents' retained earnings are and what other adjustments are necessary. So let's talk about what the working is. We'll start off with parents' retained earnings at the year end, and then we adjust the parents' retained earnings. For example, if we had any deferred consideration, the interest on that consideration must be deducted from the parents' retained earnings. Deferred consideration is discussed in another video. Moreover, whatever the subsidiary's growth is, the CI percentage, CI stands for controlling interest. How much of the subsidiary's growth belonging to the parent is added to the parent's retained earnings? How do we calculate the subsidiary's growth, or what is the subsidiary's growth? Remember the net assets table. The net assets table shows the subsidiary's assets at 2 points in time, at the date of acquisition and at the date of consolidation. The sum of those two columns and the difference between these two is representing the subsidiary's growth. And we take that growth and we multiply it by the controlling interest percentage. It shows how much of the sub is belonging to the parent. The next line we have is the PUP adjustment. We've talked about PUP adjustment before. If the parent sells to the subsidiary making a profit, this needs to be eliminated because the consolidated accounts are being prepared pretending that the parent and the subsidiary are one single entity. And if you are one single entity, you selling to yourself and you making a profit does not make sense. So if the parent made the profit when selling the subsidiary's goods, then the parent must eliminate this profit by the means of a PUP adjustment. And finally, if the subsidiary has suffered an impairment, part of that impairment must be suffered by the parent as well. So wherever the impairment is, you multiply it by the controlling interest percentage and you deduct it from the parent's retained earnings, and then you get the consolidated reserves to be shown on the face of the balance sheet. That is the working behind it. Now let's apply it to this beautiful example, Anita and Benita. On the 1st of October 15, Anita purchased 75,000 of Benita's 100,000 equity shares when Benita's retained earnings amounted to 90,000. On September 17, extracts from the statement of financial position for the two companies are given as follows. So we're given the parents and the subsidiaries' share capital, we're given their retained earnings and therefore their totals. What is the consolidated reserves which should appear in Anita's consolidated statement of financial position as at September 17? So in order for us to calculate what the consolidated reserves are, we need to prepare Benita's net assets. Benita's net assets will be shown at 2 points in time, at acquisition and at consolidation. And the net asset shows share capital, share premium, retained earnings, any adjustments, any depreciation, and any PUP adjustments. But for this particular example, the share capital is 100,000. Remember, they're going to be the same at both points in time. And the retained earnings figure is also given in the scenario. The retained earnings at acquisition were 90,000, and the retained earnings at consolidation, shown on the SFP, is 150,000. If you add the two up, you get their totals. And the difference between these two, which is 60, that represents the subsidiary's growth. So using the information from the net assets list, let's calculate the consolidated reserves. The consolidated reserve starts off with 100% of the parent's retained earnings at the year end. And using the information from the previous slide, that is 300,000. And then we do any adjustments to the parent's retained earnings. There weren't any in this question. And then we show the subsidiary's growth. The subsidiary's growth is 60,000, but you multiply the controlling interest shares of that. What is the controlling interest share? Remember, the subsidiary has 100,000 shares, but Anita bought 75,000 of those shares. So 75,000 shares divided by 100,000 shares, this means that Anita has a 75% controlling interest and therefore a 25% non-controlling interest. But for the consolidated reserves, working 75% multiplied by the subsidiary's growth, that is 45,000 added to the parent's retained earnings. So if you add that up, we get 345,000 to be shown as retained earnings on the face of the consolidated SFP. And there you have it, guys, consolidated reserves.